Vietnam has an extremely strong foundation for long-term economic growth. The country's population is nearing the 100 million mark and is expected to continue to grow through to the mid-2050s. The country has a young and growing working age demographic, with the under 35 segment representing more than 70% of the total. Political stability in the country and a pro-market agenda, including commitment to core infrastructure development, has led to it being one of the fastest growing economies in the Asia region over the last decade. Today, we'll explore some of the investment opportunities within this exciting frontier market within Southeast Asia. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In today's episode, we speak to Dominic Scriven, chairman of Dragon Capital, Vietnam's largest private asset manager, and a company he founded in 1994, making it the longest established independent fund manager based in the capital markets of Vietnam. Dragon Capital is the manager of the 1.2 billion market cap London-listed investment company Vietnam Enterprise, or VEIL. VEIL is one of the longest running funds focused on Vietnam and uses many of the attractions of a listed, closed-end fund structure to invest directly into domestically listed businesses focused on the mega trends which are central to the investment case in Vietnam. These include the growth of domestic consumption and increasing urbanization within the country. Dominic, through his work with Dragon Capital, has been a hugely successful and influential active promoter of financial market development, good governance, and sustainability within the country. We were grateful to catch up with him on a call from over in Vietnam during the recent Lunar New Year holiday, and at a time whereby the clear trend of increasing foreign direct investment towards the country seems to be accelerating as the corporate strategy of global businesses continues its attempts to diversify supply chains away from a reliance on China. Hi, Dominic. How are you? Good afternoon to you. I think it's still morning here in London, but good afternoon to you, I think, over in Hanoi. But how are you today?
Hi there, Gordon. Nice to see you. It's hot and sunny here because it's a hot and sunny time of year, but very nice to see you. And you're that far away, yes. Hello.
Good stuff, yeah. I should say a particular thank you for sparing some time, because I know it's right in the middle of the Lunar New Year holiday, so I hope you managed to have a nice break and a bit of a celebration over the last few days. But I mean, for the first question we tend to ask on these discussions is try and get a kind of a bit of an insight into you and your kind of working week. So I just wonder whether you could maybe share any anecdotes from recent meetings you've had, or even just a kind of book or article that you've been reading, just to kind of let us get to know you a little bit better.
Yeah, well, so Dragon, our firm, is 30 years old, so it's not new, but the work remains extremely interesting. So, obviously investment is uppermost in the mind, and so there's a lot of that populates the week. We're spending quite a lot of time internally. When one of the biggest problems that fund management companies face is they don't manage succession very well. So we've been spending a number of years now addressing the succession process through the firm to allow young people to rise and older people to move on, but still remain wise within the structure. But then I suppose the other point that I particularly enjoy is, we sort of call it advocacy, but it's really much more about market development. We might touch on this later in the conversation, but there are a lot of issues in terms of developing capital markets which are still new to Vietnam, because the markets are only like 24 years old, started in 2000. So there's a lot of work working with regulators, sharing knowledge, etc. So that's work, but I still have time for pleasure. I'm a big history reader. I don't really read much fiction these days. I think that's part of the aging process. I'm the most interesting book I recently read was called A Wager. And it's a story of the ill-fated British naval expedition to try and capture a special Spanish galleon off the south coast of South America. And it went horribly wrong, and lots of people died and were shipwrecked, and there's even supposedly cannibalism. But in the end, they did manage to get one part of one galleon. But I read it just because Britain is a seafaring nation, as they say, the only nation that can fight with the sea at its back all the way around. I'm not naval or military in any respect, but the lives that people lived in those years in those boats, just extraordinary. And then, of course, to make it relevant, I was actually interested in what impact the naval history of Britain has had on Britain's woodlands. And there's a big debate, because it takes like 2,000 oak trees to build a man of war. And you go, well, there were men of war all over the place. But my friend pointed out to me that there's been an important study done about this, and the price of timber did not change very much in the 18th century. And people use that to indicate that the growth of the Navy and its consumption of timber didn't cause desecration of the woodlands, but actually stimulated a forestry industry. That's counterintuitive to me, because there must have been a great deal of forest cutting, but that's what the current argument would have it. Anyway, that's my
no, fascinating. Yeah, no, thank you for that. Yeah. Let's move on to Vietnam. Obviously, a country with kind of huge economic growth potential. Not least it's from its demographic profile, or just purely from its kind of geographic positioning. But one question that is sometimes asked with the kind of less mature economies is just whether the stock market itself, those kind of domestically listed companies, offer kind of sufficiently high quality opportunity to capture that economic growth. And I wondered if you can maybe, just to kind of start this conversation, to kind of talk us through, first of all, the kind of main highlights that you see with the Vietnamese economy, but also the kind of depth of opportunity within the market as you see it, if that makes sense.
Yeah, I think that's a very good question. With developing countries in general, is the relationship between the real economy and the financial economy. And as you hint, Gordon, it's by no means certain that the one mirrors the other. And I think that there are a couple of points. One is economic activity that you can access in the market. That part of economic activity which is driving the real economy, i.e., is it apples and apples? But an equally important question is, what's the financial discipline, the structure of the financial architecture of the country? For example, do countries, persistently run negative interest rates? Is there a real cost of capital? What are the flow factors? Are there domestic investors? Are there institutions? What's the degree of openness? What's the degree of governance? Actually, all of these are equally important. In Vietnam, I think, when people look at where Vietnam gets into the newspapers, it's because it's, as you rightly pointed out, it's 100 million people, great demographics continuing to grow by nearly 1 million a year. It's large, and it's got good pro-market economic policies that have been learned from elsewhere in Asia, and it's very cost competitive. And so Vietnam is now a massive exporter, a big trader, and in many senses, right, come onto this, it's being viewed as some form of a diversification point for people, over heavy in China. So these are all the factors. But when you look at the markets, you don't see any of you don't see very much of the trade, and you don't see very much of the foreign investment. What you do see is the urbanization of the country, the industrialization of the country, the growth of infrastructure, and above all, the growth of middle income Vietnam and consumer spending. So there's not a direct match there, but there's an indirect match. And And in terms of the sort of the superstructure, but for some reason, Vietnam has had a very well run. There've been one or two dangerous lapses over the last 20, 30 years, but broadly speaking, we've had positive real interest rates for 28 out of the last 30 years. Now, that's an indication of a mindset that goes, you can't extort money from people, you have to pay people. So there's a sense of monetary and financial discipline. Anyway, all of that means, and this is not a marketing comment here, but our longest strategy dates from the beginning of the markets is 2000, so 23 years, and that puts us at about a pretty steady, varies from year to year, but compounded at 11 to 12% a year. So what that tells you is that the engines are somehow reflected in positive returns in the market. It's a good question, one to study.
I wonder, it's a slightly linked question really, but if we look at Vietnam's kind of growth prospects against some of the other economies in Asia, I mean, when we kind of look across Asia, there's such a diverse range of differing economies, whether it be due to kind of political rule or the richness of natural resources, which you mentioned. But I mean, how would you compare and contrast the kind of the prospects of Vietnam against some of its neighboring economies?
Well, you're quite right. Asia is a big area. And let's talk about East Asia, maybe, or East and Southeast Asia. Let's also talk about South Asia, because that takes over the whole world. So Vietnam is essentially an East Asian country. So in cultural terms, it's closer to China, Japan, Korea, Taiwan, although it's located rather closer to Southeast Asia. Southeast Asia tends to be rich in resources, whereas East Asia is not so rich in resources. Most of Asia at the moment actually has got declining demographics. Vietnam is one of, I think, the Philippines and Indonesia, the only other two countries really that are showing, positive demographics. There has long been talk in Asia of what people call the waterfall effect, and this dates from, really, you could go back to the end of World War II and Japan and the regrowth of the Japanese economy, and then from Japan, this sort of spillover effect from Japan to the newly industrialized countries, Korea, Taiwan, Hong Kong, Singapore, and then from then into the newly industrializing economies, which was, Malaysia and Thailand and Indonesia and Philippines, and Vietnam sort of came last. Well, actually, then China happened, of course. When I started work, nobody talked about China at all, right? That in the 80s, because China just hadn't opened, and then China sort of did open. But to answer your question, to me, the dead ringer Vietnam is Guangdong province, where people might not like me saying this, but Guangdong province is the southernmost province of China. It's about the same size, about 100 million people, and it's the province to which Deng Xiaoping paid a visit in 1979 and said, "To get rich is glorious." Lines like, "It doesn't matter whether the cat is black or white, so long as it catches the mouse." And that's where essentially the Chinese sort of modern miracle began. And Vietnam is very similar. And of course, frankly, it's right next door. So, that would be my dead ringer. Yeah. I mean, more generically, the Vietnamese, benchmark themselves against what we call the ASEAN 4. So they look at the Philippines, Thailand, Indonesia, and Malaysia. And in most measures would look to see whether, growth rates, income levels, stability, the speed with which you can dock a boat and unload a container, the cost of labor, the cost of power. And so that's the proximate sort of benchmark group. At the moment, I think Indonesia is doing quite well. But really, if you look in the whole of Asia, if you look at GDP growth rates, Indonesia is growing quite well and Vietnam's growing quite well.
I mean, one of the kind of recent trends, you mentioned it in kind of passing on a previous question, that's benefiting Vietnam is that kind of change in global corporate strategy. Some people call it that kind of China plus one strategy of kind of diversifying supply chains, whether that was triggered by the pandemic or kind of trade relations over recent years. But would you be able to give us a sense of just how significant you think that could be for Vietnam, and how you think that might play out over the years to come, as if that trend really does start to lay its tracks?
Yes, well, you mentioned, Gordon, China plus one, and this is a key mantra these days, isn't it? But some of your listeners might not be aware that actually China plus one dates back to SARS in 2003, when the world's garment industry was almost entirely based in China, and SARS was this horrible flu that petrified everybody, and the garment supply chain just went dead. So you got the garment industry beginning to diversify on the basis you had to have an alternative to China. But then, of course, there's been a whole succession of cost increases in different countries, availability of labour. Sometimes there are political issues, which mean that people want to diversify their risk. And then, of course, you've got 2010, President Obama, and he came up with this policy called the Trans-Pacific Partnership, which was an attempt then to sort of draw a fence to begin to delineate China from non-China. Then, of course, Trump didn't take any part. He pulled out of that. But then Trump launched his own issues against China. And then, yes, as you say, the pandemic created further issues to supply chains. And now we got the recent. So it's actually a long continuum that I would say is at least 20 years. And, in the case of Vietnam, to the credit of the government, they've always been very open to foreign investment. In fact, their foreign investment law came before their domestic company law, if you can imagine that, right? And and of course, because it's stable, right? Vietnam is a stable place, notwithstanding, the history a long time ago. It's currently pretty stable. And so people like stability. If you're a direct investor, you need stability, and you need a workforce that works. It's very important how many days off people want to need. What's the structure of their overtime? Do people strike? These sort of issues are also productivity, is I guess what we're talking about. So FDI, as we call it, foreign direct investment, has been pretty significant in Vietnam for as long as we've been working. What I mean by significant is it's never really been below 5% of GDP a year. Last year, I think it was over 6%. I would say it's between 5 and 7% a year of GDP. And this is people bringing in new factories, new technologies, and of course, new export markets. And strangely and surprisingly, it's continued to grow as the Vietnamese economy has grown. FDI has continued to keep that 5 to 7% share. By comparison, what the government spent, and that's about what the government is spending on infrastructure at the moment. And we talk about an infrastructure boom at the moment. Well, an infrastructure program for sure. So the government's trying to spend on infrastructure, and it's spending about the same as foreign investors spend every year. How long will that continue? To the extent that politics are involved, we can never really see that enormously clearly. But if you take the totality of cost competition, geographic location of supply chain, productivity, size, availability of labor, I would say Vietnam's pretty well, and stability, of course. Vietnam's pretty well positioned. And where are the competitors? Well, of course, we were reading about them, haven't we? There's nowhere really in Southeast Asia. People talk about Myanmar, but unfortunately that's not working, is it? Bangladesh is interesting. India, of course. But then you're beginning to get away from the East Asian. Your classic manufacturer, probably has a factory in Korea, or a factory in China, factory in Vietnam, and possibly a factory in Thailand. And they're trying to pull all these bits together. And if you have to then go all the way off to, South Asia, it does produce complications. Yeah. So we feel generally constructive on that aspect of the future.
Yeah. I mean, one thing that often comes up when we talk about Vietnam is it is still classified as a frontier market within those kind of widely used benchmark indices, and so many kind of traditional fund managers, if they're looking at Vietnam, it is, I mean, what would often be termed a kind of off benchmark position if they were to do that. I mean, I wondered if you could kind of talk us through how the market's progressing to achieve that emerging market status. I mean, it's obvious that the market could clearly get there. It is there in many classifications, but I mean, how is that progressing, and how significant could that be?
Well, I'd have to caution you and your listeners that we've been wrong on this before, so I'm a little bit what I'm saying, but let's try and put the picture. So you're quite right. Vietnam is what's called a frontier market, which is a very small group of markets. It's actually the biggest market. It's like nearly 30% of that particular index. And that index doesn't work very well. Not many people follow it. So what everybody looks at more is the emerging markets index, which is a huge index. And I mean, you know, China is 50% of it. But even if you take China out, there's still a lot in that index. And a lot of our clients view Vietnam as a de facto emerging market, which it is if you look at size and turnover and number of companies and all that sort of stuff. But because the index companies haven't yet got comfortable, it's not termed officially an emerging market, which, as you say, means that any professional institution that takes a view on Vietnam is essentially taking an off-index bet. So you could probably say that the amount of international capital that is invested in Vietnam is way below its potential, which would happen. So what are we talking about here? Well, GDP is heading to $500 billion. The markets are around $250 billion. There are 1,500 companies. Turnover is between 500 million and $1 billion a day. You know, that's not bad. The valuation of companies is roughly, I would put it around 10 times earnings looking forward, which is lower than, for example, the Philippines or Malaysia or Singapore or Taiwan. And there are two reasons for this. One is the reason that you've just mentioned, which is that you know, it's not yet an emerging market, and so foreign investors feel less mandated to invest. I'll come back to it. The other is the growth, the growing participation of domestic investors. So as incomes grow in a country, deposit rates tend to decline. People then tend to need to have things to invest in to protect their savings when they grow old. And we're seeing this trend quite. In fact, we used to have a chart in our deck that compared Vietnam with Taiwan, because what's happening in Vietnam is exactly the same as what happened in Taiwan in the 1990s. You see the number of people growing. I think last month, which wasn't a good month, I think we were close to 80,000 new securities accounts, so 80,000 people opening accounts to invest in the stock market. So that's probably the bigger factor. But to your question, anybody who reads about Vietnam will read that this year there's a specific attempt to tackle this problem. And I don't think it's worth boring your listeners with the technical innards of the situation, but suffice to say that there are one or two technical issues which the index companies are saying means they can't. The biggest one of these is pre-funding. So if you're an investor, put your money into Vietnam, into Vietnamese dong, before you can put your order on. Now, you know, you or I might be able to do that, maybe, but institutions, they don't like that. In fact, they really don't like it. And so the key, there's a lot of effort going on here to find a way around so that foreign investors are not forced to pre-position, as it's called, pre-fund their trades. Now, if that can happen in a credible way, which is what we're led to believe is on the books for this year, then one of the index companies, I'm led to believe, will favorably view Vietnam towards emerging market status. All of this, I think, from a Vietnamese angle, we should reflect, sits into its evolution. So next year is 2025, which any historians amongst us will know is 50 years after 1975, the year when Vietnam was unified from two countries into one. And every government agency is racking its brains to find some form of KPI to mark that very significant point in Vietnam's modern history. And I know in our own industry that, the regulators, they would just love to see Vietnam emerging market in 2025. But as I say, I've been wrong before, so I'm not so sure.
Absolutely, yeah, no problems. Our final question is sometimes seen as the trickiest one. I'm going to ask you for your kind of highest conviction area from an investment perspective this time. I mean, could there be, it doesn't have to be a kind of single stock, but is there kind of one single investment theme that you pick out in the Vietnamese market at the moment that you'd highlight as being particularly attractive?
Yes, well, I don't know what answers you've had before. I mean, I could give you, a list of stocks in various portfolios, but I don't think that's as relevant as one single point, which has catalyzed both our successes and our failures over the last 30 years. It's essentially the role of governance in companies. So, there's sometimes there are companies in which you invest and you know that you can go to sleep and not have nightmares about what's going to happen in that company. And there are different sort of management structures. It could be family run in some cases, it could be groups of individuals, it could be, ex-state enterprises. They all could possibly fit the bill of good governed companies. But what I've learned is that companies that are not governed well are risky, and they can go up in the short term, but they very rarely go up consistently. And so our absolute key focus in Dragon is good governance, and there are many aspects to that. The way that they treat individual shareholders, the way they treat minorities, transparency of information, how they deal with audit, how they deal with compensation, what their plans are for succession, what's their risk, what's the risk appetite that you see through their business planning, and their focus on business, their core competencies, do they stray beyond them? All of these things are they're all the soup all the way to the nuts of our job, I think. And so, we invest in 120 companies. The one feature about all the companies in which we happen to be investing is that they're well governed. Yes.
Yeah, I couldn't agree more with that. And I think the governance issue is often put on emerging and frontier markets, but that absolutely applies to markets all across the world. So yeah, 100% agree with what you've just said. Dominic, thank you so much for sparing some time, particularly on the New Year holiday. But I really appreciate your time and really interesting to chat. So thank you.
Thank you, Gordon, and thank you to your listeners. And have a great week ahead.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority.